valuations, outlook for emerging markets, what's happening in India. I have the perfect guest, Adrian Lim. He joins us live from his Singapore office. Adrian, always a pleasure to have you on ET Now. Thank you for joining us. Now, Adrian, for equity investor, this is real springtime. In India, we are saying this time Diwali has come early, and global investors are saying the Santa has come early. The move in equity as an asset class, and especially emerging market equities, is relentless.
Yeah, that's what we've been seeing in the last, actually it's been a steady improvement and a very quick recovery since the lows in the region in March and April. I think if you compare India against developing markets as well as the Asian region as a whole, India is quite slow in the June quarter, but has picked up momentum recently. And that's nice to see a reallocation back. I think part of that has to do with quite a few macroeconomic developments that are global, because we see this strong rally, or what you call spring, has come early, not just in India, but across capital markets. But part of that has also got to do with India-specific issues. So clarity on the US elections, the rising amount of positive news flow on vaccine development has contributed. And the fact that in India, although the COVID pandemic remains a big challenge, there are pockets which where the numbers and the statistics have looked to mature and in various phases of stabilizing. So the vaccine helps positive sentiment with respect to that.
Adrian, when you speak to global capital allocators and when you speak to some of your LPs and big clients, what is your sense? Do you think the flows which have come to emerging markets, are they structural in nature? Could this trend last for next couple of years?
Oh, that's difficult to say. I think whether it's for global allocators or regional allocators or just us on the ground picking stock and picking the merits of various companies, we do need to remain quite nimble. I think if you talk about the interest in emerging markets, that's a trend that we've seen that sustained over the last decade or two. Specifically, Asia has attracted its fair share of capital, given it's been able to deliver on quite a few of the promises and the potential that it's been holding out for a while. Strong demographics, rising middle class, more prudent fiscal policies, and generally reform and liberalization of legal as well as financial frameworks. So those things need to continue happening. And if that happens, yes, the capital allocator into developing markets, into India, will continue. Having said that, there will be bumps and bruises along the way. And but as long as the fundamentals continue to be moving in the right direction, we will get a disproportionately larger amount of capital.
What has Adrian Lim been doing in India? Have you increased your allocation to India or have you maintained status quo?
Well, I work for Aberdeen Standard Investments, so it's not so much what Adrian Lim does as a group, as a team. We had been taking a little bit of profit off the table from India in the about 12 months back. And then with the initial COVID shutdowns that we had in Q1 and Q2 in the calendar year Q1 2020, we had been taking some profits off the table from India. We were very concerned with the public health issue and how that has stressed the society and the markets in India itself. And that has proved to be true. As it is a very big challenge for a country that's this diverse and this spread out. The challenge is not over yet, but we do see the resilience of some of the companies that we've been investing in. And we do see that for many of the companies that we do like, there are strong teams in place, strong financial discipline in place, and a very clear focus on the business models that they want to implement. So because of that, we've been encouraged by the recovery in the share prices of some of these companies. And therefore, we are now, over the last 2-3 months or so, we have been selectively adding to the stocks that we like. It has to be very selective, though, because even in the emerging markets, there are big sectors that will continue to struggle over the next 1 or 2 years. Travel-related business, tourist-related business will continue to see some structural challenges for the medium term until things have stabilized on the healthcare front.
So if you have to talk about emerging markets right now, Adrian, for next 2 to 3 years, which are your preferred markets?
It's difficult to generalize. I mean, even in some of the small markets, you have ideas that are interesting. Some of the larger markets that have got interesting ideas as well. If we just focus on the Asian emerging markets, we like what we see in China. We like what we see in India. We like what we see in certain parts of Southeast Asia. So there are pockets of good quality companies with resilient balance sheets that are continuing to focus on their business, because when the times were good, they were prudently run and they were not overstretched. So now when things are difficult, they can do sensible things, evaluate sensible deals, and continue to invest in either their distribution network, their people, or their R&D. And so I think there are pockets of these opportunities in many emerging markets. India is one of them. China is the other one.
Adrian, for the longest time I've interacted with you, one thing never changes, which is that your top positioning or your top allocations, they rarely change. And if I look at whatever information is available in the public domain, your top 4-5 holdings have not changed. Are you excited about owning, let's say, an HDFC Limited or an ICICI Bank, or for that matter, Infosys? Because you were owning these stocks in the pre-COVID period. Post-COVID, a lot has changed for some of these companies.
Well, if you look at I won't comment on the stocks that we have dropped, but basically, if you look at our top 5 positions over the last, in the regional portfolios, as well as the country-specific strategies, there have been changes over the last 1 year, 3 years, 5 years, and some of the model weights, some of the weights have changed as well. So, there are some stocks there are about 10 to 15 stocks that are the core building blocks of what we like in India. They're attractive for what they are within their peer group, within the domestic economy. And some of these stories have got legs. They are not. We typically don't get into a stock that we think will do well for 6 months and then we get out and look at things from a short-term perspective. We typically look at stock that we think will have 3, 5, 8 years execution plan for good growth, without the company having to take unnecessarily silly risks. And then we monitor them on a continuous basis for execution. And if these companies continue to do well and continue to execute their long-term plan well, there's no reason to chop and change. There will be times when their share prices do well, and then we'll take a little bit more off the table and reduce their weights. But there's no reason to completely turn over your portfolio at a high pace when the fundamental story that's been delivered by these stocks remain intact.
So Adrian, let's just, for the benefit of our viewers, you've had a very large exposure to Indian private banks, and that call of yours or that position of yours has given you market beating returns. If you have to position, let's say, a large part of your portfolio for next couple of years, which is one theme you would like to align in India as your big mega trend?
There's so many interesting things happening in India on the ground. I think the biggest one we think, which is expressed in our strategy that we have in our Indian funds, is that we like the strength and the quality of the banks that we get within the sector, private banks that we get within the sector. You can easily find 2 or 3 of these banks that they are not necessarily cheap. I would say they're fairly priced, but they could provide good value because they execute well. They are prudent with the way they manage capital on their balance sheet. They're very shrewd about how they put money to work, whether that's on a lending portfolio or an investment portfolio. And they are very progressive when it comes down to investing and positioning their bank for the already starting digital revolution within the banking and the financial space. So I think that's a trend that's interesting because it marries the need of the country for credit. It leverages off very strong franchises that are pan-Indian. And it uses that resource and that capital by positioning itself to be, I don't like to use the word future-proof, but to make itself improve the chances of it being continually relevant for the way its sector and its customers are developing and changing. So we like that space a lot. Because of that, you would know that we have things like Kotak Mahindra, HDFC, both HDFC Holding Company and HDFC Bank. And we think that they will give us superior returns over the long term.
Adrian, you continue to like Indian consumer staples, even though the naysayers would say that Indian consumer stocks are the staple stocks like HUL, Asian Paints, they are very expensive. What do you expect the return could be from some of these stocks, given that the valuations for Asian Paints, HUL and some other FMCG stocks which you own is quite expensive?
The sector has always been expensive. I think that's to do with the fact that people like it's difficult to say exactly what portion, what factor contributes to a particular portion of, a sector having a premium. But there's some structural strengths within the sector itself. Number one, you have strong brands that people identify with, that people trust. And the quality of these brands mean that, if you've got a choice on the shelf, the consumer will tend to pick a handful of these brands and will continue to do so during good times as well as difficult times. These brands continue to introduce product innovation or brand or marketing innovation into the way they communicate the strengths of their products, the way they assure their consumer base about the relevance of their products. And they continue, as a result of that, to maintain reasonably stable margins during difficult times. On the back end, they do a very good job in procurement and production and processing. There's continuous improvement there. They are not the type that will tend to relax or take the foot off the pedal when it comes down to targeting operational efficiencies, and that's something that we continue to see. And though the broad line, the top line growth may be less exciting than some of the more technology-driven ideas in India itself, these growth trajectories should be relatively resilient and relatively predictable and visible over the medium to long term. You also get this fact that most of these companies there are a few of these companies where they don't tend to chop and change. It's not a very, it is fragmented in the sense that you have a lot of choice, a lot of sub-brands, a lot of, package sizes, but the key names will not change. There are a handful of brands with strong brand recall, strong brand names, but they don't rest on their laurels. They continue to enhance their advertising and promotion work to make sure that they remain relevant to the market, and those things are not going to change. So the likes of Hindustan, Unilever, Nestle, or Godrej are not going to change anytime soon. And therefore, you have effectively, I won't say oligopolistic power, but you have very strong power within these companies themselves with respect to the customers they serve. So there are reasons why they are relatively expensive, but some of these reasons don't look like they will disappear anytime soon.
Adrian, I'll ask you a tough one here. It's always difficult to predict future returns. But looking at the valuations and the fact that Indian markets have got their first upgrade cycle in 23 quarters, do you think Indian markets in dollar terms have potential to give double-digit returns for next 2-3 years?
It is possible. It is possible. I think you do need to look at. That's a very big question because that accounts for quite a lot of things that the Indian economy is responsible for, and also things that the Indian economy is not responsible for. I think, for example, the weakness in US dollar is something that's key to the answer to that question, and that's something that's difficult to predict. I think global geopolitical stability is another one that's difficult to predict. Pre-pandemic, we had so many things that we need to keep track of, the various rivalries between the various countries and nation states in the region, where many of the emerging countries, economically emerging countries, have strong, proud traditions historically, and therefore wanted their space on the global table for influence. And that will continue to prevail, when the pandemic issues stabilize. So those are just two areas which would need to be relatively stable for a good level of returns to come true. India as a whole have got a lot of potential for continued growth at the private sector and at the public sector. Consumption recovery is important, and when that stabilizes, it will encourage the cyclical capex and investment that's required for the next level of medium-term growth, and that will come true somewhat. Other than that, so I think that there are a few uncertainties there. We have an overweight in India against the benchmark in our regional funds. So clearly, we believe the chances of that happening is higher than low. So, better than average, not higher than low, better than average. And we think that India is a good place to put capital to work selectively in companies that you do know and trust.
Adrian, you have ownership in cement, and now for the first time, India's biggest cement company, after a gap of many years, has said that, look, we are looking at expanding capacity. Do you think in India now, the capex cycle, which in a sense has been the missing link, has picked up, and there is scope for cyclicals and industrial stocks also to rally?
I think it's promising that statement came out. We'll have to see whether it's got legs or not. But we do have quite a bit of cement exposure as well. So we are positioned for that. But, one statement doesn't make a sustainable trend in the short term. So we'll see how that develops.
Adrian, at a global level, we understand that a lot of funds now are very conscious about following best practices when it comes to ESG. You think that is going to make investing look very, very different in the next couple of years?
Yeah, I think that will make investing quite different. It's a trend that's been gathering speed and importance, but it's a really interesting thing to look at and analyze. To give you some perspective of how we see things, ESG as a buzzword has been relevant the last 5-6 years, but the G component in ESG has always been something that we've been looking at very closely over the last 2 decades or more. So governance to us is really important, and environmental and social issues were important, but they weren't given the due recognition that they deserve. I think overall we do need to look at this issue in a more granular fashion, though, because it's quite difficult to generalize and to say that a company is good because it doesn't meet certain criteria, or bad just because it doesn't meet certain criteria. We really need to understand specifically what the issues are, and many of these issues are quite dependent on the sectors and on the companies that they invest in, and the companies that we invest in. So that's something that we should look at more carefully. We have boosted our ESG teams in the region and globally as well. So it's an area that we will continuously focus on. And best practices is important, but the direction of travel is important as well. It is really important for us to identify companies that are not just the best at what they do, but that are also striving to be good at these ESG issues and are seriously looking and considering how they can improve and commit to being better. So that's just as important as, who's the best currently.
Is it still a big no from Adrian Lim when it comes to investing in Indian PSU stocks, because now they are cheap and attractive?
Well, I don't think that we have. When you ask us that question on whether we have a lot in PSUs, the answer is always no. I would never say we don't ever. We've had PSU stocks in the past. There are times that we do buy PSU stocks, but for us, it's not just about price and having something cheap. It has to be of a certain quality, and the quality here means the business prospects, the quality of the management, the strength of the balance sheet, the direction of focus, and the quality of execution. We have Container Corporation, for example, which is one of the important PSU stocks. So I won't say we would never, but I would say that we'll look at it open-mindedly. But historically, if you look at what we hold in exposure to the PSU universe against what the benchmark is, we've almost always been underweight.
Adrian, closing comments. In markets, understand it more than anyone else, that markets, they always follow a pattern or they always follow a style. Sometimes growth investing works, sometimes dividend investing works, sometimes value investing works. What kind of investing style do you think we are in now?
That's a difficult question. I think it assumes that there's no overlap at all between growth and value and income, and that's not true. There are stocks that have performed continuously with growth, but are in sectors that are not typically associated with growth. So I think if you ask me about sentiment, I think with the bounce that we have had in India, I think people are just buying what they like, buying what is liquid, and buying what they think will recover. I don't think there's a clear-cut pattern at this stage. So that some of the growth have done well, some of the value have done well. India's not a very big income universe. or the yield is not competitive in the region, so that hardly ever comes to play in India.
So Adrian, I'm tempted to ask you just one last question and then we'll not extend our appointment with you. What, to your mind, is the biggest risk which we are not talking about it right now because markets are blinded with liquidity, but this is something which you need to keep on your horizon?
I think for India, COVID remains a difficult one to say that you're insulated from. I mean, even in North Asia, with some of the countries that have done a good job managing and containing COVID risk, you can't say that you're totally insulated from a second wave or a third wave or whatever wave it may be. The vaccine news the news of vaccine development has been encouraging, but it by no means is a fail-safe position for the development and the recovery of the markets as yet. So I think there's been some over-exuberance. I think that's the one that's tricky to see. If we had some bad news flow from the vaccines, I don't think the enthusiasm will dissipate, but it would knock some wind off the sails.
Adrian, so in the pandemic, what has kept you busy? Which are the books you've read? Which are the shows you watched? I'm tempted to ask you more like a reckoner from you. What are the books you would like to recommend? What are the articles you would like to recommend to our viewers?
I'll read what you like. There's a lot of time, supposedly, but it's been a challenging time. I think we've been effective we've been fortunate enough to be effective working from home, but it's not the most efficient time. So although you have some flexibility with time, you don't always have the volumes that you kind of expect working from home after cutting away commuting and traffic time.
All right, Adrian, stay safe. Certainly hope to see much more of you going forward and have a wonderful year ahead.
Okay, thank you very much. All the best to you and your viewers as well.
Well, let's take a break with the news that for the moment UPL is not bouncing back. Bajaj Finance has bounced back. So I guess this trend's going back to financial once again. That's what the screen seems to be indicating. The breadth is phenomenally better than what it was. ONGC, crude spike, ONGC goes higher. Very simple to connect that. Even the crude has gone up. We've not seen any large smattering in HPCL or BPCL. I guess it would be, when petrol in India, at least in Mumbai, is at 90 rupees per litre. With oil at these prices, let's see how oil marketing companies would respond. So that, in a sense, is going to be another topic of debate now, that what will happen to fuel prices with such high taxes and now crude coming back.